Backtesting a trading strategy. Backtesting is a fundamental process in quantitative finance, serving as a cornerstone for validating and refining trading strategies before their deployment in live markets. At its core, backtesting involves simulating the execution of a trading strategy using historical market data to assess its hypothetical performance. This rigorous simulation provides crucial insights into how a strategy would have performed under past market conditions, offering a data-driven basis for evaluating its potential profitability, risk, and overall viability. What is backtesting? Backtesting can be defined as the process of applying a set of trading rules or an algorithm to historical market data to determine the theoretical outcome. Imagine you have a new idea for when to buy or sell an asset. Instead of risking real capital immediately, backtesting allows you to travel back in time and see if your idea would have generated profits or losses. It's a form of historical simulation that replicates the conditions of trading over a specific past period. The primary objective of backtesting is to answer critical questions such as, would this strategy have been profitable? How much risk would it have exposed me to? How consistent would its performance have been? How would it have performed during different market environments? Why is backtesting critical? Backtesting is not merely an optional step. It is a critical component in quantitative trading for several reasons. 1. Strategy validation. It provides empirical evidence of a strategy's historical performance, helping to validate its underlying logic and assumptions. Without backtesting, a strategy remains a theoretical concept. 2. Risk assessment. By simulating trades, backtesting allows for the calculation of various risk metrics, such as maximum drawdown, code snippet, volatility, and value at risk, code snippet. This helps traders understand the potential downsides and manage risk effectively. 3. Performance evaluation. It enables the calculation of key performance indicators, KPIs, that objectively measure a strategy's effectiveness, such as annualized returns, Sharpe ratio, and Sortino ratio. 4. Iterative improvement. Backtesting is an iterative process. Initial backtests often reveal flaws or areas for improvement. Traders can refine their strategy's parameters, rules, or even its core logic, then rebacktest to see if the changes lead to better results. This continuous feedback loop is essential for optimizing strategies. 5. Informed decision-making. The insights gained from backtesting inform the decision of whether to deploy a strategy live, allocate capital to it, or discard it entirely. It reduces reliance on intuition and replaces it with data-driven confidence. The role of historical data. The quality and representativeness of the historical data used are paramount to effective backtesting. If the data is flawed, incomplete, or does not accurately reflect our real-world market conditions, the backtest results will be misleading. Representative trading periods. A robust backtest does not rely on a single, favorable historical period. Instead, it involves testing the strategy across a diverse range of market conditions, often referred to as representative trading periods. This is crucial because a strategy that performs well in a bull market might collapse in a bear market or during periods of high volatility. Examples of representative trading periods include bull markets, periods of sustained upward price movement; bear markets, periods of sustained downward price movement, potentially including significant market crashes, e.g., 2008 financial crisis, dot-com bubble burst; sideways/range-bound markets, periods where prices fluctuate within a relatively narrow range without a clear trend; high volatility periods, times of extreme price swings, e.g., flash crashes, periods around major economic announcements; low volatility periods, times of calm and steady price movements; specific historical crises, testing against well-known market events, e.g., Black Monday, COVID-19 pandemic onset, to assess resilience under stress; different economic cycles, evaluating performance during periods of economic expansion, recession, and recovery. By testing across these varied regimes, one can gain a more comprehensive understanding of a strategy's adaptability and robustness. For instance, a momentum strategy might thrive in trend-in G markets, but struggle in sideways markets, whereas a mean reversion strategy might perform inversely. Different strategy types. Backtesting is applicable to a wide array of quantitative trading strategies, each with its own characteristics and sensitivities to market conditions. Momentum strategies. Buying assets that have performed well recently, expecting continued outperformance. Mean reversion strategies. Betting that asset prices will revert to their historical average after extreme deviations. Arbitrage strategies. Exploiting small price discrepancies between different markets or instruments. Statistical arbitrage. Using statistical models to identify mispriced securities relative to their peers. Trend-following strategies. Identifying and riding market trends. Each of these strategies will exhibit unique performance characteristics across different market phases, underscoring the importance of diverse backtesting. Understanding strategy robustness. Robustness refers to a strategy's ability to maintain its effectiveness and profitability across various market conditions, different parameter settings, and even with slight variations in its underlying logic. A truly robust strategy is not overly sensitive to minor changes or specific market quirks. How backtesting aids robustness analysis. Backtesting facilitates robustness analysis by simulating trades under varied conditions. As discussed, running the same strategy across different market regimes, bull, bear, volatile, calm, reveals how its performance metrics change. A strategy that performs consistently well, or at least within acceptable parameters, across these diverse conditions is considered more robust. Sensitivity analysis. This involves systematically changing the input parameters of a strategy, e.g., the look-back period for a moving average, the threshold for a signal, and rerunning the backtest. If the strategy's performance drastically changes with minor parameter tweaks, it might be overfitted or not robust. Stress testing. Specifically testing a strategy during periods of extreme market stress or historical crises to see how it withstands adverse conditions. High-level example, bull versus bear market performance. Consider a simple trend-following strategy that buys when a short-term moving average crosses above a long-term moving average and sells when it crosses below. In a bull market, this strategy is likely to perform well. As prices consistently rise, the short-term average will mostly stay above the long-term average, leading to profitable long positions. In a bear market, the strategy would likely struggle. During a sustained downturn, it would primarily generate short signals, which could be profitable if shorting is permitted. However, in choppy bear markets with sharp rallies, it might suffer from whipsaws, leading to frequent small losses as signals reverse quickly. In a sideways market, this strategy would likely perform poorly. Without clear trends, moving averages would frequently cross, generating false signals and leading to numerous small losses due to frequent small losses due to transaction costs. This simple example illustrates why testing across different market phases is crucial for understanding a strategy's true robustness and identifying its strengths and weaknesses. Key considerations and limitations of backtesting. While indispensable, backtesting is not without its limitations and common pitfalls. Awareness of these can help prevent misleading results and lead to more realistic expectations. Common pitfalls. 1. Look-ahead bias. This is arguably the most dangerous pitfall. It occurs when a backtest uses information that would not have been available at the time the simulated trade was made. For example, using future closing prices to make a trading decision at the open. Even subtle forms, like using data that is released with a lag, can introduce this bias. 2. Overfitting. This happens when a strategy is excessively optimized to fit past data, often by tweaking numerous parameters until it perfectly explains historical movements. An overfitted strategy typically performs exceptionally well in a backtest, but fails miserably in live trading because it has learned the noise and specific quirks of the historical data rather than robust underlying patterns. 3. Survivorship bias. This bias arises when the historical data used only includes assets that have survived, i.e., are still trading TOTA. Why? Excluding those that have been delisted, gone bankrupt, or merged. If a backtest is run only on current index components, it ignores the performance of companies that failed and were removed from the index, artificially inflating historical returns. 4. Transaction costs. Backtests often underestimate or entirely ignore the impact of transaction costs, which include commissions, exchange fees, and taxes. These costs can significantly eat into profits, especially for high-frequency strategies. 5. Slippage. This refers to the difference between the expected price of a trade and the actual price at which the trade is executed. In fast-moving markets or for large orders, the actual execution price can be worse than the quoted price. Many simple backtests assume perfect execution at the specified price, which is unrealistic. 6. Data quality issues. Inaccurate, incomplete, or incorrectly adjusted historical data, e.g. for dividends, stock splits, mergers, can lead to erroneous backtest results. Data quality and intricacies. Beyond the common pitfalls, the practical implementation of backtesting involves navigating several complexities related to data and execution simulation. Data cleaning. Raw historical data often contains errors, missing values, or outliers that need to be identified and corrected. Handling corporate actions. Events like stock splits, dividends, mergers, and spin-offs significantly impact historical prices and need to be accurately accounted for to ensure price continuity and prevent miscalculations. Proper order execution simulation. A sophisticated backtesting engine needs to accurately simulate how orders would have been filled in the real market, considering factors like bid-ask spreads, market depth, and order types, e.g., market orders, limit orders, stop orders. Simple models that assume trades execute at the close price of a bar are often insufficient for realistic assessment. Key performance metrics in backtesting. Introduction. To quantitatively evaluate a strategy's performance during backtesting, various metrics are employed. These metrics provide a standardized way to compare different strategies and assess their risk-adjusted returns. While these will be covered in detail in later sections, a brief introduction is useful. Sharpe ratio measures the risk-adjusted return of an investment. It indicates the amount of return earned per unit of risk. A higher Sharpe ratio generally implies a better risk-adjusted performance. Sortino ratio, similar to the Sharpe ratio, but it focuses only on downside deviation, bad volatility, rather than total volatility. It's often preferred by traders who are more concerned with downside risk. Maximum Drawdown. Code snippet represents the largest percentage drop from a peak in equity to a trough before a new peak is achieved. It's a crucial measure of a strategy's worst-case loss and risk of ruin. Compound annual growth rate. CAGR, the average annual growth rate of an I. Investment over a specified period longer than 1 year, assuming the profits are reinvested. It provides a smooth rate of return. Roadmap to practical implementation. This section has laid the conceptual groundwork for understanding backtesting, what it is, why it's important, and its inherent limitations. Subsequent sections will transition from the theoretical why to the practical how. We will delve into the technical aspects of building a backtesting framework, exploring specific programming languages such as Python and relevant libraries, e.g., code snippet, code snippet, code snippet, code snippet. These future discussions will cover data acquisition, strategy implementation, execution simulation, and the calculation and interpretation of performance metrics, providing the tools necessary to perform robust backtests. Introducing backtesting. Backtesting is a fundamental and indispensable process in quantitative finance, serving as the bedrock for evaluating the viability and robustness of any trading strategy. At its core, backtesting involves applying a defined set of trading rules to historical market data to simulate how the strategy would have performed in the past. This data-driven simulation provides an objective assessment of a strategy's potential profitability, risk characteristics, and overall effectiveness before any real capital is committed. The purpose and benefits of backtesting. The primary goal of backtesting is to move beyond theoretical concepts and provide concrete, quantifiable evidence of a strategy's past performance. This objective approach offers several critical benefits. Objective evaluation. Unlike discretionary trading, which relies heavily on intuition and subjective judgment, backtesting provides an unbiased, data-driven assessment. By systematically applying rules to historical data, it removes emotional biases and allows for a clear, empirical understanding of a strategy's strengths and weaknesses. Comprehensive risk and return analysis. A successful trading strategy isn't just about generating profits. It's also about managing risk effectively. Backtesting allows quants to calculate a wide array of performance metrics, providing a holistic view of a strategy's risk-adjusted returns. This includes understanding potential drawdowns, volatility, and overall consistency of returns. Strategy robustness and adaptability. Markets are dynamic, constantly shifting between different phases, e.g., bull, bear, volatile, sideways. Backtesting across diverse historical periods helps assess how robust a strategy is under varying market conditions. A strategy that performs well only in a specific market environment might not be suitable for live deployment. Parameter optimization. Many trading strategies incorporate adjustable parameters, e.g., the look-back period for a moving average, the threshold for a signal. Backtesting facilitates the systematic optimization of these parameters. By testing various combinations, traders can identify the settings that historically yielded the best performance metrics, though this process must be handled carefully to avoid overfitting. Early identification of flaws. Backtesting often uncovers unforeseen flaws or logical inconsistencies in a strategy's design. Issues such as excessive transaction costs, unexpected whipsaws, or poor performance during specific market regimes become apparent during the simulation, allowing for refinement or rejection of the strategy before it incurs real losses. Key considerations and common pitfalls in backtesting. While powerful, backtesting is not without its challenges and potential pitfalls. Awareness of these considerations is crucial for conducting meaningful and reliable simulations. Maintaining time sequence. The most fundamental rule of backtesting is to adhere to the time sequence of data. All calculations, signal generations, and trade executions must only use information that would have been available at that precise moment in time. This means that when evaluating a strategy's decision on a particular day, you can only use data from that day and all preceding days, never from future days. Data snooping and look-ahead bias. This is arguably the most dangerous pitfall in backtesting, often leading to strategies that appear profitable in simulation but fail miserably in live trading. Data snooping refers to the unconscious or conscious use of information that would not have been available at the time the trading decision was made. This creates an overly optimistic and unrealistic performance projection. Explicit examples of data snooping and look-ahead bias include future data and indicator calculations, calculating a moving average or any other technical indicator using future closing prices. For instance, if you're making a decision at the close of today, you cannot use tomorrow's closing price in your calculations. Optimizing on the final test set. If you optimize your strategy parameters, e.g., finding the best moving average periods, by running backtests on the entire historical dataset, including the final period you intend to use for out-of-sample evaluation, you are effectively peaking at the future performance. The parameters chosen will be biased towards that specific dataset. Using future event information. Incorporating knowledge of future events, such as an earnings announcement or a geopolitical event that occurred after the simulated trade decision was made. This concept is directly analogous to the critical principle in machine learning where the test set must be completely kept away from the model training and tuning process. In quantitative trading, this means your final, independent test period should never influence your strategy development or parameter selection. If you optimize on your test data, your strategy might simply be curve-fitted to past noise rather than possessing true predictive power. Training, validation, and test periods. To mitigate data snooping and ensure a robust evaluation, it's essential to divide your historical data into distinct periods. Training period In sample, this initial segment of data is used for the primary development of your strategy rules and for initial parameter exploration. It's where you form your hypotheses and refine your logic. Validation period, out of sample, walk forward after initial development. This period is used for fine-tuning strategy parameters. Instead of optimizing on the entire dataset, you optimize on this unseen during training segment. This helps validate that the chosen parameters generalize somewhat and are not merely overfitted to the training data. A common practice is walk-forward optimization, where the training and validation windows slide forward over time. Test period, out of sample. Unseen, this is the most crucial period. It is a completely independent dataset that has never been used for strategy development, rule refinement, or parameter optimization. The performance on this period provides the most unbiased estimate of how the strategy might perform live. No adjustments or optimizations should ever be made based on the results from the test period. If the strategy performs poorly here, it should be reevaluated or discarded. Representativeness of historical data. Backtesting on a single, short period or a period dominated by one market phase, e.g., a long bull market, can lead to misleading results. A strategy that looks fantastic during an extended uptrend might collapse during a bear market or a period of high volatility. It is crucial to choose multiple representative trading periods that encompass a variety of market conditions. This includes bull markets, periods of sustained price increases; bear markets, periods of sustained price declines; sideways/consolidation markets, periods where prices trade within a narrow range; high volatility markets, periods with large, rapid price swings; low volatility markets, periods with subdued price movements. By assessing a strategy's performance across these different phases, you gain a more realistic understanding of its robustness and adaptability, identifying if it's truly resilient or merely a fair-weather strategy. Transaction costs and slippage. Ignoring or underestimating transaction (STS), commissions, exchange fees, and slippage, the difference between the expected price of a trade and the price at which the trade is actually executed, can significantly inflate simulated profits. A strategy that appears profitable without these considerations might become unprofitable once real-world trading costs are factored in. Realistic backtests must incorporate these elements. Survivorship bias. When using historical data for stocks or other assets, ensure the dataset includes delisted or bankrupt companies. If your data only contains currently existing companies, you introduce survivorship bias, as you are only evaluating strategies on assets that survived and thus likely performed better, creating an unrealistic positive bias. Key performance metrics. During backtesting, various metrics are calculated to quantify a strategy's performance and risk. While a full deep dive into each is beyond this introductory section, a few core metrics are essential. Total return. The simple percentage gain or loss from the start to the end of the backtesting period. Annualized return. The total return normalized to a one-year period, allowing for comparison across strategies with different backtesting durations. Volatility. Standard deviation, a measure of the dispersion of returns around the average return. Higher volatility indicates greater price fluctuation and risk. Sharpe ratio, a widely used risk-adjusted return metric. It measures the excess return above T. The risk-free rate, per unit of total risk volatility. A higher Sharpe ratio indicates better risk-adjusted performance. The formula is generally code snippet. Maximum Drawdown represents the largest peak-to-trough decline in the value of the portfolio during the backtesting period. It quantifies the worst historical loss an investor would have endured from a peak in value to a subsequent trough. This metric is crucial for understanding potential capital at risk. Kalmar ratio, Sortino ratio, alpha, beta, other advanced metrics that provide deeper insights into risk-adjusted returns, downside risk, and market correlation. Understanding parameter optimization. Many trading strategies are not rigid, but contain adjustable parameters that influence their behavior. For example, a moving average, MA, crossover strategy requires defining the look-back periods for the short and long moving averages. Parameter optimization is the process of finding the most effective combination of these parameters by iteratively running backtests. The general process involves 1. Defining parameter ranges. Specify the minimum and maximum values and the step size for each parameter you wish to optimize. 2. Iterative backtesting. Run a backtest for every possible combination of parameters within the defined ranges. This is often referred to as a grid search. 3. Performance evaluation. For each backtest, calculate key performance metrics, e.g., Sharpe ratio, total return. 4. Selection. Identify. Why the parameter set that yields the best results according to your chosen optimization objective, e.g., highest Sharpe ratio. It's critical to perform parameter optimization only on the training and validation periods, never on the final, unseen test period, to avoid overfitting. Conceptual walkthrough, a simple backtest example. To solidify the understanding of backtesting, let's consider a simplified, step-by-step conceptual walkthrough for a very basic strategy. A simple moving average, SMA, crossover. Strategy. By signal, when the 10-period SMA crosses above the 50-period SMA. Sell signal, when the 10-period SMA crosses below the 50-period SMA. The flow of a conceptual backtest. 1. Data acquisition. Load historical daily price data, e.g., adjusted close prices, for the asset you want to test, e.g., SPY ETF, over a specific period. This data must be time series ordered. 2. Iteration. The backtesting loop. The core of the backtest is a loop that iterates through each day or bar of your historical data from the earliest date to the latest. 3. Signal generation. At each bar. For the current day, calculate the 10-period SMA and the 50-period SMA using only the data available up to and including the current day. Compare the current day's SMA values with the previous day's SMA values to detect a crossover. If a buy signal is generated and you're not currently in a long position, prepare to buy. If a sell signal is generated and you're currently in a long position, prepare to sell. 4. Trade execution. If a buy signal is active, simulate placing a buy order at the current day's closing price or next day's opening price, depending on your model. Deduct the simulated cost of the trade, shares price plus transaction costs, from your cash balance. Record the trade in a log. If a sell signal is active, simulate placing a sell order. Add the proceeds to your cash balance. Record the trade. 5. Position management. Keep track of your current holdings, number of shares, average entry price, and your current cash balance. Update your total portfolio value, cash plus value of holdings, at the end of each day. 6. Metric accumulation. As the backtest progresses, record daily portfolio values to form an equity curve. Also, log details of each trade, entry price, exit price, profit/loss date. 7. Final analysis. Once the loop finishes, use the accumulated equity curve and trade log to calculate all the desired performance metrics, total return, Sharpe ratio, maximum drawdown, etc. Code strategy. Pseudocode illustrations. Let's illustrate the core concepts of backtesting with pseudocode, demonstrating how these ideas translate into a programmatic structure. Basic backtesting loop structure. This pseudocode outlines the fundamental loop that processes historical data bar by bar, applying strategy rules and tracking portfolio changes. Download the code on OnePageCode Substack. This first chunk establishes the main loop of a backtest. It iterates through each day's data, ensuring that all decisions are made based only on information available up to that point. It manages the simulated cash and open positions, executes trades based on signals, and tracks the overall portfolio value, which forms the code snippet. Transaction costs are also conceptually included for realism. Parameter optimization using grid search. This pseudocode demonstrates how you might systematically test different combinations of parameters for a strategy, like the look-back periods for moving averages. Download the code on OnePageCode Substack. This second chunk illustrates a grid search for parameter optimization. It iterates through predefined ranges of parameters, e.g., different moving average periods. For each combination, it configures the strategy and runs a backtest using the code snippet function. The performance of each combination is then evaluated using metrics like the Sharpe ratio, and the best performing parameters are identified. This process is typically applied to training and validation data. Conceptual calculation of performance metrics. Finally, these pseudocode snippets show the basic logic for calculating some of the key performance metrics from the code snippet generated by the backtest. Download the code on OnePageCode Substack. This final chunk provides conceptual implementations for calculating key performance metrics like total return, Sharpe ratio, and maximum drawdown. These functions would typically be called after a backtest run is complete, using the generated code snippet data. The Sharpe ratio calculation demonstrates the process of annualizing daily returns and standard deviation, while maximum drawdown shows how to track the largest peak-to-trough decline. Caveats of backtesting. While backtesting is an indispensable tool for evaluating quantitative trading strategies, it is not a crystal ball. A robust backtest demonstrates how a strategy would have performed on historical data, but it offers no guarantee of future performance. Financial markets are dynamic, complex systems with inherent uncertainties, and a multitude of pitfalls can lead to misleading backtest results. Understanding these caveats is crucial for any aspiring quant trader to interpret backtest results with the necessary skepticism and rigor. Why past performance isn't indicative of future results. The adage, past performance is not indicative of future results, is particularly poignant in quantitative trading. The primary reasons for this disconnect stem from the fundamental nature of financial markets. Low signal-to-noise ratio. Financial data is characterized by an extremely low signal-to-noise ratio. This signal refers to predictable, exploitable patterns or relationships that drive asset prices in a consistent direction. The noise, conversely, encompasses random fluctuations, unpredictable events, market microstructure effects, and the collective irrationality of market participants. Consider a stock price chart. Much of the daily, hourly, or even minute-by-minute movement is random noise. The underlying signal, e.g., a company's fundamental value, a macro trend, is often obscured by this noise. This makes it incredibly challenging to differentiate genuine, repeatable patterns from mere coincidences in historical data. Models trained on noisy data are highly susceptible to picking up on these coincidental patterns, which are unlikely to persist in the future. Non-stationary markets. Financial markets are inherently non-stationary. This means that the statistical properties of market data, like mean, variance, and autocorrelation, change over time. Economic regimes shift, regulations evolve, technological advancements alter market structure, and participant behavior adapts. A strategy that performed exceptionally well during a bull market might collapse in a bear market, or one optimized for a period of low volatility might fail during high volatility. This non-stationarity makes extrapolation from historical data perilous. A model that perfectly describes past relationships might become entirely irrelevant as market dynamics shift, leading to a significant divergence between backtested and live performance. Overfitting. Overfitting is perhaps the most dangerous pitfall in quantitative strategy development. It occurs when a model is excessively complex or too closely tailored to the specific historical data it was trained on, capturing not only the underlying signal, but also the random noise unique to that dataset. While such a model might show spectacular performance on the historical data in sample performance, it performs poorly on new, unseen data out of sample performance because the patterns it identified were merely coincidental artifacts of the training data. Imagine trying to predict a student's test scores. If you create a model that is so specific it memorizes every answer from past tests, it will perform perfectly on those past tests. But when given a new test, it will likely fail because it hasn't learned the general principles, only the specific answers. Hypothetical numerical example. A strategy might show an impressive 25% annualized return with a Sharpe ratio of 1.5 in a backtest spanning 10 years. However, if this strategy is overfit, when deployed in live trading, it might only yield a meager 2% return or even a loss because the specific market conditions or data quirks it exploited in the backtest are no longer present. Illustrative code example, polynomial overfitting. To illustrate overfitting, let's use a simple example of fitting a polynomial to some noisy data. We'll generate synthetic data with a clear underlying trend plus random noise, then try to fit polynomials of different degrees. A high-degree polynomial will demonstrate overfitting. First, let's import the necessary libraries and set up our synthetic data generation. Download the code on one patch code Substack. This initial code block sets up a synthetic dataset. We create code snippet values, our independent variable, perhaps representing time or a market factor, and code snippet values following a clear quadratic relationship. Then, we add random code snippet to simulate the k-ind of noisy data found in financial markets, resulting in code snippet. The plot helps visualize the underlying signal and how it's obscured by noise. Now, let's fit two polynomial models, one with a low degree, e.g. degree 2, which should approximate the true relationship, and one with a high degree, e.g. degree 15, which will overfit. Download the code on one patch code Substack. In this second code block, we define a helper function code snippet that takes our data, a polynomial code snippet, and encodes snippet object for plotting. It constructs a code snippet pipeline with code snippet to fit the data. We then call this function twice, once for code snippet, which visually approximates the true relationship well, capturing the signal, and once for code snippet. The code snippet model clearly twists and turns to capture every single data point, including the noise, demonstrating overfitting. While it fits the training data perfectly, it would perform poorly on new data points not seen during training. Mitigation of overfitting. The primary defense against overfitting is to ensure that your strategy's performance is robust on data it has not seen during the development and optimization process. 1. Out-of-sample testing. Holdout set. The most fundamental technique is to divide your historical data into at least two distinct sets. In-sample, training, data, used for developing, optimizing, and calibrating the strategy. Out-of-sample, test, data, a completely separate segment of data, chronologically after the in-sample data, used only for a final, unbiased evaluation of strategy. The strategy parameters should be fixed before testing on this data. If the strategy performs well in sample but poorly out of sample, it's likely overfit. 2. Cross-validation. 4 time series. While traditional k-fold cross-validation is common in machine learning, it's problematic for time series data due to the inherent sequential dependency. Randomly splitting data breaks the temporal order, leading to look-ahead bias, discussed later. 4 time series, specialized cross-validation techniques are used. Walk-forward optimization, rolling window. This involves repeatedly training the model on an initial segment of data, testing on the next, immediate future segment, and then rolling both windows forward. This simulates how a strategy would be optimized and traded in real time. Blocked cross-validation. Similar to k-fold, but data is split into blocks, and the validation blocks are always chronologically after the training blocks. Purged and embargoed cross-validation. More advanced techniques that consider the temporal dependency and potential data leakage from overlapping observations, e.g., for strategies with long holding periods. The general principle is to ensure that the model never sees the future data it is being tested on, either directly or indirectly. Data snooping and data dredging, p-hacking, closely related to overfitting. Data snooping, also known as data dredging or p-hacking, occurs when an analyst repeatedly tests various hypotheses or tweaks strategy parameters until a statistically significant result is found. This process increases the probability of finding spurious correlations that are merely due to chance, rather than a genuine underlying market phenomenon. For example, if you test 100 different moving average crossover strategies on the same dataset, by pure chance, a few of them are bound to show impressive profits, even if they have no predictive power. The more parameters you optimize, e.g., look-back periods, thresholds, asset universes, and the more combinations you test, the higher the risk of data snooping. This is a critical concern because financial markets have a low signal-to-noise ratio. There are an infinite number of patterns one could discover in historical data, but very few of them are truly predictive. Data snooping exploits this by finding the patterns that happen to work well in a specific historical period. Survivorship bias. Survivorship bias occurs when the dataset used for backtesting only includes assets that currently exist or have survived up to the present day. This omits assets that have delisted, gone bankrupt, been acquired, or otherwise ceased to exist during the backtesting period. Impact on returns. If a backtest only considers surviving companies, it inherently overestimates past returns because it excludes the poor performers that failed. For our example, a backtest of a strategy based on S&P 500 stocks might use a current list of constituents. However, over a 20-year period, many companies would have been removed from the index due to poor performance or bankruptcy. By ignoring these failures, the backtest implicitly assumes you would have held onto winning stocks and avoided all the losing ones, which is unrealistic. Conceptual code/data handling for mitigation. To mitigate survivorship bias, it is essential to use a survivor bias-free dataset. This means using historical databases that include delisted securities and accurately reflect the index constituents at any given point in time. Download the code on OnePatchCode Substack. This conceptual code demonstrates the need for a code snippet that explicitly includes delisted companies and provides methods to query the universe of available stocks on a specific date. This ensures that a backtest does not inadvertently select stocks that only exist today, but rather accurately reflects the investment opportunities and failures that were present at each point in historical time. Relying solely on current index constituents or readily available data for active stocks will lead to survivorship bias. Trading costs and market impact. One of the most common reasons for a discrepancy between backtested and live performance is the failure to accurately account for real-world trading costs and market impact. These costs, though seemingly small per transaction, can accumulate significantly and erode profitability, especially for strategies with high turnover. 1. Transaction costs, commissions, and fees. These are the direct costs charged by brokers for executing trades. They can be fixed per trade, a percentage of the trade value, or a per share/per contract fee. Example: a commission of $0.005 per share or 0.1% of trade value. 2. Bid-ask spread. The bid-ask spread is the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask. When you buy at the ask and sell at the bid, you effectively lose the spread on each round trip. Example: if a stock's bid is $100 and its ask is $100.05, the spread is 5 cents. A round trip, buy and sell, costs you 5 cents per share. 3. Slippage. Slippage occurs when the actual execution price of a trade differs from the expected price at the time the order was placed. This is common in volatile markets or for large orders, where the market price can move significantly between the time an order is sent and when it is filled. Example: you place a market order to buy a stock at $100, but due to market movement, it gets filled at $100.07. You experience 7 cents of slippage. 4. Market impact. Market impact refers to the effect that your own large orders have on the price of the security. If you try to buy a very large quantity of a stock, your buying pressure can push the price up and selling can push it down, leading to worse execution PR. ICE is for subsequent parts of your order. This is particularly relevant for institutional traders or strategies dealing with illiquid assets. Accumulated cost calculation example. Even seemingly small costs can have a dramatic effect on profitability over many trades. Let's demonstrate this with a simple calculation. Download the code on OnePatchCode Substack. This code defines a function code snippet that takes the number of trades, average trade size, and various percentage-based costs. It then applies these to a hypothetical scenario of 2,000 trades per year with an average trade size of $10,000. Even with seemingly small percentage costs, 0.05% commission, 0.1% spread, 0.05% slippage, the accumulated annual cost can be substantial, $4,000 in this example. If a strategy's gross profit is, say, $50,000, then $4,000 in cost represents 8% of the gross profit, significantly eroding net returns. For strategies with higher turnover or lower gross margins, these costs can easily turn a backtested profit into a live loss. Practical example scenario. Consider a high-frequency mean reversion strategy that aims for small profits on many trades. A backtest might show a 1% average profit per trade. Backtested $100,000 monthly profit into a $95,000 profit, or even a loss if the gross profit margin was tighter. Accurate estimation of these costs is paramount. Backtests should always incorporate realistic estimates for all trading costs. For market impact, advanced models or conservative assumptions based on average daily volume and order size are often necessary. Other biases and pitfalls. Beyond the major caveats discussed, several other biases can compromise the integrity of a backtest. Look-ahead bias. This occurs when a backtest uses information that would not have been available at the time the trading decision was made. Examples include using future stock splits, dividend adjustments, or updated company financials that were not yet public. For instance, if a strategy uses a company's final annual earnings report for a given year, but that report was released several months after the year ended, using it prematurely in a backtest introduces look-ahead bias. The solution is to ensure that all data used for a decision point was historically available at that exact moment. Liquidity constraints. A backtest might assume that any size of trade can be executed at the last traded price. In reality, trading large positions, especially in less liquid assets, can be challenging. Orders might not be filled completely, or they might significantly move the market price, leading to worse execution than assumed. Realistic backtests should incorporate models for order execution. On and liquidity constraints. Model risk. This refers to the risk that the mathematical or statistical model underlying the strategy is flawed or makes incorrect assumptions about market behavior. Even if perfectly implemented and backtested, a fundamentally flawed model can lead to catastrophic losses in live trading. The collapse of long-term capital management, LTCM, in 1998, while complex, highlighted how even highly sophisticated models can fail when market conditions deviate significantly from their underlying assumptions, e.g., correlations breaking down during a crisis. This emphasizes that models are simplifications of reality, not perfect representations. Understanding maximum drawdown. Maximum drawdown, MDD, is a crucial risk metric in quantitative trading and portfolio management. It quantifies the largest peak-to-trough decline in the value of an investment portfolio or trading strategy over a specific period. Unlike volatility, which measures the dispersion of returns, MDD focuses specifically on downside risk, representing the worst historical loss an investor would have endured if they had invested at a peak and sold at a subsequent trough. The significance of MDD extends beyond a mere historical loss figure. It provides a stark reminder of the potential pain an investor might experience, influencing investment psychology, capital allocation decisions, and overall risk appetite. A strategy with a high MDD, even if it has high average returns, might be deemed unacceptable by investors who prioritize capital preservation or have strict risk tolerance limits. For quant traders, understanding MDD helps in setting appropriate stop-loss levels, sizing positions, and evaluating the robustness of a strategy under stress. Conceptual calculation of maximum drawdown. The calculation of maximum drawdown relies on the concept of a wealth index or equity curve, which tracks the cumulative value of a portfolio over time, typically starting from an initial value, e.g., 100 or 1.0. From this wealth index, we need to identify the highest points, peaks, and the subsequent lowest points, troughs, before a new peak is reached. The conceptual steps are as follows. 1. Calculate the wealth index. This is the cumulative product of 1 plus daily/period returns, starting from an initial capital. 2. Determine the cumulative peak wealth. At each point in time, identify the highest wealth achieved up to that point. This is also known as the high water mark. 3. Calculate drawdown. For each point in time, the drawdown is the percentage decline from the cumulative peak wealth achieved before or at that point. It's calculated as code snippet or code snippet. Since drawdowns represent losses, these values will be negative. 4. Identify maximum drawdown. The maximum drawdown is simply the largest, most negative value in the series of drawdowns calculated in the previous step. Let's illustrate this with a small, hand-traceable numerical example. Suppose we have a wealth index for a strategy over 6 periods. Period wealth index, cumulative peak wealth drawdown, current/peak, 1. 0, 100, 100, 100/100. 1 is equal to 0.00. 1, 110, 110, 110/110. 1 is equal to 0.00. 290, 110, 90/110. 1 is equal to minus 0.1818. 3, 120, 120, 120/120. 1 is equal to 0.00. 4, 80, 120, 80/120. 1 is equal to minus 0.3333. 5, 100, 120, 100/120. 1 is equal to minus 0.1667. In this example, the wealth index starts at 100. At period 1, wealth is 110, so the cumulative peak is 110. At period 2, wealth drops to 90. The cumulative peak up to this point is still 110 from period 1. So the drawdown is 90/110. 1 is equal to minus 0.1818 or minus 18.18%. At period 3, wealth rises to 120, setting a new cumulative peak of 120. Drawdown resets to 0. At period 4, wealth drops to 80. The cumulative peak is 120 from period 3. So the drawdown is 80/120. 1 is equal to minus 0.3333 or minus 33.33%. At period 5, wealth recovers to 100. The cumulative peak is still 120. Drawdown is 100/120. 1 is equal to minus 0.1667 or minus 16.67%. Looking at the drawdown column, the most negative value is minus 0.3333. Therefore, the maximum drawdown for this period is 33.33%. Programming maximum drawdown calculation. Implementing MDD in Python typically involves using libraries like CodeSnippet for time series data and CodeSnippet for numerical operations. We'll progressively build the code, starting with data preparation and then moving to the core MDD calculation. Step 1. Prepare the wealth index. The first step is to obtain or calculate the wealth index. This usually involves starting with a series of daily or periodic returns and then computing their cumulative product. For simplicity, we'll start with a sample series of daily returns. Download the code on OnePageCode Substack. This initial code block sets up our code snippet series and then transforms it into a code snippet. The code snippet operation effectively compounds the daily returns, showing how an initial investment would grow or shrink over time. We multiply by code snippet to set a base value, which is often 100 or 1.0 for easy. Our interpretation as a percentage growth. Step 2. Calculate the cumulative peak wealth. The cumulative peak wealth, or high water mark, at any given point is the maximum value the wealth index has reached up to that point in time. This is crucial for identifying how far the current wealth has fallen from its most recent peak. Download the code on OnePageCode Substack. The code snippet method from Pandas is highly efficient for this task. It iterates through the code snippet and, for each value, stores the maximum value encountered so far. For example, if the wealth index is code snippet, the code snippet would be code snippet. Step 3. Calculate the drawdown series. With the wealth index and cumulative peak wealth, we can now calculate the drawdown at each point in time. The drawdown is the percentage decline from the current cumulative peak. Download the code on one patch code Substack. This code snippet series shows the percentage drop from the high water mark at every point. A value of code snippet indicates that the wealth index is at a new peak or has just recovered to a previous peak. Negative values represent the percentage decline from the last peak. Step 4. Identify the maximum drawdown. The maximum drawdown is simply the largest, most negative value in the code snippet series. Download the code on one patch code Substack. The code snippet method directly gives us the largest percentage drop. It's common practice to express MDD as a positive percentage, e.g., 20% DR. Drawdown, not minus 20% drawdown. So we often multiply by minus 100 or just report the absolute value. Step 5. Encapsulate in a function for reusability. To make this calculation reusable, it's best practice to wrap it into a dedicated function. This function can then be part of a larger backtesting utility module. Download the code on one patch code Substack. This function code snippet takes a code snippet of returns and in code snippet, defaulting to 100.0, and returns the MDD. It includes a basic check for an empty code snippet series to prevent errors and return a meaningful code snippet. This function is robust enough for most backtesting needs. Related drawdown metrics. While Maximum Drawdown provides the largest percentage drop, it doesn't tell the whole story of drawdown risk. Two other related metrics offer a more complete picture. Drawdown duration. This measures the length of time from a peak to a trough, or from a peak until the wealth index recovers to a new peak. A long drawdown duration indicates that capital was tied up and underperforming for an extended period, which can be psychologically challenging and impact opportunity costs. Even a smaller MDD can be problematic if its duration is excessively long. Recovery time. This is the time taken for the wealth index to recover from a trough back to its previous peak. It's a specific aspect of drawdown duration, focusing on the recovery phase. A quick recovery is desirable, as it means the strategy efficiently regains low SD ground. Understanding these metrics helps in evaluating the quality of a drawdown. A strategy with a 20% MDD that recovers in a month is often preferred over one with a 15% MDD that takes 2 years to recover. Maximum drawdown and risk management. MDD is a critical input for various aspects of risk management in quantitative trading. Capital allocation. A high MDD might indicate that a strategy requires a larger reserve of capital to weather potential losses without risking ruin. Conversely, strategies with lower MDD might allow for higher leverage or position sizing for the same risk budget. Strategy selection. When comparing multiple strategies, MDD is a primary filter. Investors often set maximum acceptable MDD thresholds, eliminating strategies that exceed these limits, regardless of their potential returns. Risk-adjusted performance. MDD is integral to several risk-adjusted return metrics, as it captures downside risk more intuitively than standard deviation. Risk-adjusted return, the Kalmar ratio. The Kalmar ratio is a popular risk-adjusted return metric that uses maximum drawdown in its denominator. It measures the average annual return of an investment relative to its maximum drawdown. The formula for the Kalmar ratio is code snippet. A higher Kalmar ratio indicates better risk-adjusted performance, suggesting that the strategy generates higher returns for the amount of pain, drawdown, it inflicts. Calculating the Kalmar ratio. To calculate the Kalmar ratio, we first need the compounded annual growth rate, CAGR, of the wealth index. Download the code on one patch code Substack. This code first defines a code snippet function, which is a common performance metric. It then uses this, along with our previously defined code snippet function, to compute the code snippet. Note that we handle the edge case where MDD is 0, e.g., for a monotonically increasing wealth curve, by returning code snippet for the Kalmar ratio, as division by 0 is undefined. Visualizing drawdowns. Visualizing the wealth curve, cumulative peak, and drawdowns is invaluable for understanding strategy performance and risk. It provides an intuitive grasp of how the strategy navigates market ups and downs. Download the code on one patch code Substack. This code snippet function generates two subplots. The top one shows the code snippet and its code snippet, while the bottom one displays the code snippet series, often shaded to highlight the periods of loss. This visual representation allows for quick identification of the deepest drawdowns, their duration, and recovery patterns. It's an indispensable tool for strategy analysis and communication. The problem with single-point worst-case metrics. Maximum Drawdown, MDD, is a widely used metric because of its intuitive appeal. It quantifies the largest peak-to-trough decline an investment portfolio or strategy has experienced historically. It provides a clear, single number representing the worst-case historical loss from a peak. However, this very simplicity is also its greatest weakness. Relying solely on MDD for risk assessment can lead to a misleading understanding of a strategy's true risk profile due to several inherent limitations. Sensitivity to outliers and data errors. One of the most significant drawbacks of Maximum Drawdown is its extreme sensitivity to outliers and data anomalies. Because MDD captures the single largest historical drop, a single erroneous data point, or an isolated, extreme market event can disproportionately inflate the calculated drawdown, making a generally stable strategy appear much riskier than it fundamentally is. Types of outliers and their impact. Outliers can arise from various sources, each presenting a distinct challenge to accurate risk assessment. 1. True extreme market events, flash crashes, geopolitical shocks. These are legitimate, albeit rare, market phenomena where prices experience rapid, severe declines followed by quick recoveries. Examples include the 2010 flash crash, the VIX event of 2018, or sudden geopolitical shocks. While these are real risks a strategy could face, a single such event might dominate the MD. Decalculation, overshadowing the strategy's typical performance during more normal market conditions. This can lead to overestimating the strategy's day-to-day risk. 2. Data recording errors. These are issues with the data itself, such as incorrect price feeds, missing data points, or transcription errors during data collection or storage. A single misplaced decimal, an accidental zero, or a corrupted entry can create an artificial drawdown that never actually occurred in the market. Such errors can easily be mistaken for genuine market movements, leading to flawed conclusions about a strategy's risk. 3. Liquidity gaps / illiquid assets. For strategies involving less liquid assets, e.g., certain bonds, private equity, or less frequently traded stocks, the reported prices might not reflect true tradable values. Sudden drops in reported value could be due to a lack of buyers or infrequent quotes rather than a fundamental decline in asset value. This can artificially inflate MDD, as the actual loss might not be realizable at the reported price. The problem is that MDD makes no distinction between these types of events. It simply identifies the deepest trough, regardless of its cause. This makes robust data cleaning and validation a critical prerequisite for any backtesting exercise. Illustrative example: outlier impact on drawdown. Let's demonstrate how a single outlier can dramatically affect the maximum drawdown calculation. We'll simulate a stable equity curve, and then introduce an artificial data error. First, we need to import necessary libraries and define a helper function to calculate MDD, building upon previous sections. Download the code on one patch code Substack. The code snippet function takes a code snippet, a time series of portfolio values, and computes the maximum percentage drop from a previous peak. We ensure it handles empty inputs and returns a positive value for clarity, which is common practice for presenting drawdowns. Now, Let's create a synthetic wealth index that generally trends upwards, simulating a stable strategy's performance over approximately 1 year of trading days. Download the code on OnePatchCode Substack. Here, we generate daily returns with a small positive mean and some volatility. Then create a code snippet by cumulatively compounding these returns, starting with an initial value of 1,000. We then print the MDD for this clean series to establish a baseline. Next, we introduce a single significant outlier into this clean series at a specific point in time. This simulates either a severe data error or a very short-lived flash crash. Download the code on OnePatchCode Substack. We create a copy of our clean series, and then, an arbitrary code snippet, we artificially reduce the value by 50%. To simulate a flash crash or a corrected data error, we also quickly recover the value in the subsequent days. This creates a sharp, isolated dip that might otherwise be overlooked by metrics that average losses. Finally, we calculate the MDD for the series with the outlier and visualize the difference between the clean and outlier-affected series. Download the code on OnePatchCode Substack. The output will clearly show how a single, isolated dip, even if quickly recovered, significantly inflates the maximum drawdown value. This illustrates that MDD can be a poor representation of typical strategy volatility or long-term risk if a single extreme event dominates the historical record. This highlights the critical importance of robust data cleaning and validation in backtesting, as well as the need for context when interpreting MDD. Dependence on data granularity. The calculated maximum drawdown is highly sensitive to the frequency at which the data is observed or sampled. A strategy might appear to have a lower drawdown when observed monthly compared to daily, simply because intramonth dips are smoothed out or missed entirely. Why granularity matters. Intra-period fluctuations. Daily data captures all intraday and day-to-day fluctuations, including temporary dips that might recover by the end of the week or month. If a strategy experiences a 15% dip intraday, but recovers to be only 2% down by market close, daily data might still register a significant peak-to-trough drop. Smooth data. Weekly or monthly data points typically represent end-of-period values, e.g., Friday close, month-end close. This aggregation effectively smooths out or completely misses any significant drawdowns that occurred and recovered within that period. For instance, a strategy might experience a 10% drop midweek, but if it recovers by Friday, the weekly data point might show only a 2% decline from the previous week's close, entirely obscuring the intra-week drawdown. True risk underestimation. If a strategy experiences frequent but short-lived drawdowns, common in high-frequency or day trading strategies, observing at a lower frequency, e.g., monthly, will make it appear much safer than it actually is. This can lead to a severe underestimation of the capital required to withstand these fluctuations and the psychological stress on a trader. Illustrative example: granularity impact on drawdown. Let's demonstrate how data granularity affects MDD. We'll use our clean daily wealth index and then resample it to weekly and monthly frequencies. Download the code on OnePatchCode Substack. Here, we use Panda's powerful code snippet method to aggregate the daily code snippet into weekly and monthly series. The code snippet aggregation ensures we take the closing value of the period, which is standard for financial data. Now, we calculate and compare the MDD for each frequency to highlight the direct impact of granularity. Download the code on OnePatchCode Substack. This comparison clearly illustrates that the code snippet appears smoother at lower frequencies, and consequently, the calculated maximum drawdown tends to be smaller. This is a critical consideration for backtesting. A strategy might appear robust on monthly data, but could experience significant, uncaptured daily drawdowns that would stress a real-world trading account. Always backtest using the highest frequency data relevant to your trading horizon and execution speed. Past performance is not indicative of future results. Perhaps the most fundamental limitation, applicable to all historical metrics, is that maximum drawdown is purely a historical measure. It tells us the worst that has happened, not the worst that can happen or will happen. Black swan events. The future might hold black swan events, unforeseen, high-impact, rare occurrences that dwarf any historical drawdown. A strategy might have a low historical MDD because it simply hasn't encountered the specific market conditions that would expose its vulnerabilities. For example, a strategy that performed well through the 2008 financial crisis might struggle in a high-inflation, low-growth environment if it's never been tested against such a regime. Regime change. Market dynamics are not static. Economic cycles, technological advancements, regulatory changes, and shifts in investor behavior can fundamentally alter market regimes. A strategy that performed well and had a low drawdown in a bull market or low volatility regime might perform poorly and experience much larger drawdowns in a bear market or high volatility regime. Historical MDD from one regime might be irrelevant in another. Strategy capacity and market impact. As a strategy scales with more capital, its own trading activity might begin to influence market prices, especially in less liquid assets. This market impact can lead to worse execution prices and potentially larger drawdowns than observed during backtesting with smaller, theoretical capital. Therefore, while MDD is a useful starting point for understanding historical risk, it should never be interpreted as a guaranteed upper bound on future losses or a definitive statement about a strategy's future resilience. Beyond maximum drawdown, a holistic approach to risk. Given these limitations, it's clear that relying solely on maximum drawdown for risk assessment is insufficient for robust quantitative trading. A comprehensive suite of risk metrics is essential to gain a more nuanced and accurate understanding of a strategy's vulnerabilities. Complementary risk measures. Several other metrics can provide a richer picture of risk, addressing some of MDD's shortcomings. 1. Conditional value at risk, CVAR/expected shortfall. While value at risk, VAR, measures the minimum loss expected at a given confidence level, e.g., 99% VAR over 1 day means there's a 1% chance of losing more than the VAR amount in 1 day. CVAR goes further. CVAR measures the average loss expected beyond that VAR level. It's considered a more robust measure of tail risk than VAR or MDD because it considers the magnitude of all losses in the extreme tail of the distribution, not just a single worst poi. NT, or threshold. Advantage over MDD. CVAR provides an average of extreme losses, making it less sensitive to a single outlier than MDD. It gives insight into the how bad scenario on average when things go wrong, rather than just a single worst historical instance. 2. Ulcer Index. This metric, developed by Peter Martin and Byron McCann, measures the depth and duration of drawdowns. Instead of just focusing on the maximum peak-to-trough drop, the Ulcer Index penalizes strategies that stay in a drawdown for a longer period or experience deeper drawdowns. It effectively quantifies the pain or stress experienced by an investor during periods of decline. Advantage over MDD. It provides a continuous measure of drawdown severity, reflecting the pain endured. A strategy with a lower ulcer index might be preferred over one with a similar MDD but longer or more frequent periods of decline. 3. Drawdown duration and recovery time. These metrics quantify how long a strategy remains below a previous peak, drawdown duration, and how long it takes to recover to a new equity high, recovery time. Importance. Long drawdown durations imply capital is tied up for extended periods, impacting liquidity and opportunity cost. Even a strategy with a moderate MDD can be problematic if it takes years to recover, locking up capital and potentially causing psychological distress. 4. Value at risk. VAR, while also having its own limitations, e.g., not measuring losses beyond the threshold. VAR estimates the maximum potential loss over a specified time horizon at a given confidence level. Complement to MDD. MDD is a historical worst-case observation. VAR is a probabilistic estimate of potential future loss based on statistical models of return distributions. They offer different perspectives on risk. Implications for robust backtesting. Understanding the limitations of MDD directly influences the design principles of robust backtesting systems, moving beyond simple metric calculation to a deeper appreciation of their nuances and limitations. Rigorous data cleaning and validation. Before any backtesting, historical data must be meticulously cleaned to identify and correct errors, missing values, and potential outliers. Strategies for handling flash crashes, e.g., filtering extreme single-period moves or using robust estimators, should be considered. Poor data quality will lead to misleading risk assessments. Multi-frequency analysis. Backtest strategies across various relevant data frequencies, e.g., daily, weekly, monthly, and even intraday, if applicable, to understand how performance and risk metrics change. This helps identify hidden vulnerabilities that might be masked by lower frequency data and ensures the strategy's risk profile is understood across different time horizons. Stress testing and scenario analysis. Go beyond historical MDD by simulating extreme, hypothetical market conditions, e.g., major market crashes, liquidity crises, periods of high GH inflation, to gauge a strategy's resilience. This helps prepare for black swan, events not present in historical data, and assesses how the strategy might perform under conditions it has never encountered. Holistic risk assessment. Always evaluate a strategy using a diverse set of risk metrics. Combine MDD with measures like CVR, ulcer index, Sharpe ratio, Sortino ratio, and others to form a comprehensive picture of risk and return. This multifaceted approach provides a more realistic understanding of a strategy's true risk profile and its suitability for real-world deployment. Calculating the max drawdown. Understanding the theoretical definition of maximum drawdown is crucial, but its practical application requires translating that theory into executable code. This section provides a step-by-step guide to calculating maximum drawdown using Python and the powerful Pandas library, a fundamental skill for any quantitative trader or financial data analyst. We will construct a wealth index from historical price data, identify prior peaks in that wealth, and then compute the percentage decline from those peaks to determine the maximum drawdown. 1. Understanding the components of drawdown. Before diving into the code, let's conceptually map the maximum drawdown definition to the computational steps. Investment value, or wealth index, this represents the hypothetical value of your initial investment over time, assuming a buy-and-hold strategy. It's built by compounding daily returns. Prior peak. At any given point in time, the prior peak is the highest value the investment value has reached up to that point. It's the high water mark. Drawdown. The drawdown at any given time is the percentage decline from the prior peak to the current investment value. If the current value is above the prior peak, the drawdown is 0%. Maximum drawdown. This is the largest, most negative percentage decline observed across the entire investment period. In common reporting, it's often presented as a positive percentage to indicate the magnitude of the loss. 2. ACWI. Ring financial data. Our first step is to obtain historical price data for the assets we want to analyze. We'll use the code snippet library, which provides a convenient way to download data from Yahoo Finance. Download the code on one patch code Substack. We begin by importing necessary libraries: code snippet for data download, code snippet for data manipulation, code snippet for numerical operations, and code snippet for plotting. We define our target stock tickers, code snippet for Google, code snippet for Microsoft, and a specific date range. The code snippet function fetches the data, returning a Pandas data frame. The code snippet method allows us to inspect the initial rows of this data frame. Download the code on one patch code Substack. The code snippet method provides a summary of the data frame, including the number of entries, column names, non-null counts, and data types. Code snippet. Notice that code snippet often returns a multi-index data frame, where the top level indicates the price type, e.g., ADJ close, close, high, low, open, volume, and the second level indicates the ticker symbol. The code snippet serves as the index, crucial for time series operations. The code snippet for price data indicates high-precision floating point numbers, while code snippet signifies nanosecond-level timestamp resolution for our dates. For drawdown calculations, the ADJ close, adjusted close, price is typically preferred because it accounts for corporate actions like stock splits and dividends, providing a more accurate reflection of the true return to an investor. Download the code on OnePageCode Substack. Here, we select the ADJ close column from our code snippet data frame. This results in a new data frame, code snippet, which contains only the adjusted closing prices for each ticker across our specified date range. 3. Calculating daily returns. To understand how our investment changes value day to day, we need to calculate daily percentage returns. This is done using the code snippet method in Pandas. Download the code on OnePageCode Substack. The code snippet method computes the percentage change between the current and a prior element. For daily data, this calculates the daily return. Notice the code snippet, not a number, value in the first row. This is expected because there's no preceding price to calculate a change from for the very first data point. These code snippet values are important to handle correctly in subsequent calculations, as they can propagate and invalidate results if not addressed. 4. Constructing the wealth index. The wealth index simulates the growth of an initial investment over time, assuming all returns are reinvested. It's built by compounding the daily returns. Download the code on OnePageCode Substack. Here, we perform a critical step. For compounding, we need to convert percentage returns into growth factors by adding 1 to each return, e.g., a 2% return becomes 1.02, a minus 1% return back. 0.99. The code snippet method then calculates the cumulative product of these growth factors. Multiplying by code snippet, e.g., $1,000, scales this index to a relatable starting value. It's important to note that while code snippet changes the scale of the wealth index, it does not affect the percentage drawdowns, as those are relative measures. We explicitly set the first row of code snippet to code snippet. As explained earlier, code snippet yields code snippet for the first period, which would propagate through code snippet, resulting in code snippet for the initial wealth. Manually setting it ensures a proper starting point for our cumulative calculations. 5. Identifying prior peaks. The prior peak at any given time is the highest value the wealth index has reached up to that point. This is essential for calculating drawdowns, as drawdowns are defined as declines from these high water marks. Download the code on OnePageCode Substack. The code snippet method is perfect for this. For each row, it returns the maximum value encountered in the series or data frame up to that row. If the current wealth index is higher than all previous values, the prior peak updates to the current wealth. If the current wealth drops, the code snippet will hold the value of the last high water mark until a new high is achieved. This accurately reflects the peak from which a drawdown is measured. 6. Computing daily drawdowns. Now that we have our wealth index and the corresponding PR peaks, we can calculate the daily drawdown. This is simply the percentage difference between the current wealth and the prior peak. Download the code on OnePageCode Substack. The formula code snippet gives us the percentage drawdown. A value of 0 indicates no drawdown, i.e., current wealth is a new peak or the prior peak. Negative values indicate a decline from the prior peak. The larger the negative value, the deeper the drawdown. For instance, minus 0.10 means a 10% drawdown from the peak. 7. Determining the maximum drawdown. The maximum drawdown is the largest, most negative value in our code snippet. We can find this using the code snippet method, and code snippet will tell us the date on which this minimum occurred. Download the code on OnePageCode Substack. Since drawdowns are represented as negative percentages or decimals, the maximum drawdown is technically the minimum value in the code snippet. For example, a minus 0.50 drawdown is larger in magnitude, a 50% loss, than a minus 0.10 drawdown, a 10% loss. So minus 0.50 is the minimum value. For reporting purposes, maximum drawdown is almost always presented as a positive percentage to represent the magnitude of the loss. Download the code on one patch code Substack, multiplying by -1 or using code snippet, and then by 100 converts the decimal drawdown into a positive percentage, which is the standard way to report this metric. Code snippet formats the code snippet object into a cleaner string. 8. Encapsulating the calcula. Tie-in a function. To promote reusability and modularity, it's best practice to encapsulate the entire drawdown calculation logic into a single, well-defined function. This allows us to easily apply it to different return series without rewriting the code. Download the code on one patch code Substack. The code snippet function takes a pandas series of returns and an optional code snippet as input. It includes type hints, code snippet, code snippet, code snippet for clarity and basic input validation. We use code snippet on code snippet before code snippet for robustness, ensuring that any leading code snippets, like the one from code snippet, or internal missing data points are treated as 0% return for compounding purposes, though the first value of the code snippet is explicitly set to code snippet afterward. It then performs all the steps we outlined, calculating the wealth index, prior peaks, and drawdowns, finally returning them in a single data frame. 9. Applying the drawdown function to different assets. Now we can easily apply our new function to the daily returns of Google and Microsoft. Download the code on one patch code Substack. By calling code snippet with code snippet and code snippet, we obtain separate data frames containing the wealth index, prior peaks, and drawdowns for each stock. This demonstrates the reusability of our function. 10. Visualizing drawdowns and performance. Visualization is key to understanding financial data. Plotting the wealth index, prior peaks, and drawdowns on the same chart provides a powerful visual representation of an investment's performance and risk exposure. Download the code on one patch code Substack. This initial plot shows the raw price movements of Google and Microsoft, giving a general sense of their performance over the period. Download the code on one patch code Substack. This visualization is particularly insightful. The top subplot shows the wealth index, representing our investment's value, and the prior peaks, the high watermark. When the wealth index dips below the prior peaks, a drawdown is occurring. The bottom subplot explicitly shows the drawdown percentage. You can observe how the drawdown drops below 0 whenever the wealth index is below its prior peak, visually confirming the relationship. The deepest point in the drawdown plot corresponds to the maximum drawdown. 11. Advanced considerations. A. Portfolio drawdown. In real-world scenarios, quant traders rarely invest in a single stock. Calculating drawdown for a portfolio of assets requires first computing the portfolio's weighted returns. Download the code on one patch code Substack. We define code snippet and then use the code snippet method to compute the weighted sum of individual stock returns, yielding the code snippet series. This portfolio return series can then be fed into our code snippet function, just like a single stock's returns. This demonstrates how the modular function design simplifies complex calculations. B. Simplified transaction costs. While comprehensive transaction cost modeling is complex, we can illustrate their impact by deducting a simplified cost from the wealth index at each period where a trade might occur, e.g., daily rebalancing, or just a small daily drag. For simplicity, we'll apply a tiny daily drag to the wealth index. Download the code on one patch code Substack. This simplified example demonstrates how even small, consistent transaction costs can slightly reduce the final wealth and potentially deepen drawdowns. In a full backtesting system, transaction costs are applied based on actual trade executions. C. Kalmar ratio. The Kalmar ratio is a risk-adjusted return metric that measures the return of an investment relative to its maximum drawdown. It's defined as the compound annual growth rate, CAGR, divided by the absolute value of the maximum drawdown. Download the code on one patch code Substack. The Kalmar ratio provides a quick way to compare strategies or assets by balancing their compounded returns against their worst historical loss. A higher Kalmar ratio indicates better risk-adjusted performance. Calculating maximum drawdown is a cornerstone of quantitative risk analysis. By understanding and implementing these steps, you gain a powerful tool for evaluating the pain an investor might endure and assessing the risk profile of various trading strategies or investments. Backtesting the trend-following strategy. This section provides a practical, hands-on demonstration of how to implement and evaluate a quantitative trading strategy using historical market data. We will focus on a simple yet foundational trend-following strategy based on moving average crossovers. By the end of this section, you will be able to acquire financial data, calculate technical indicators, generate trading signals, compute strategy returns, and assess performance using key metrics such as annualized return, volatility, Sharpe ratio, and maximum drawdown. 1. Setting up the environment and acquiring data. The first step in any quantitative analysis is to prepare your Python environment and obtain the necessary historical data. We'll use popular libraries like CodeSnippet for data manipulation, CodeSnippet for numerical operations, CodeSnippet for downloading financial data, and CodeSnippet for visualization. Download the code on OnePageCode Substack. Here, we import CodeSnippet for handling tabular data, like stock prices and indicators, CodeSnippet for mathematical operations, CodeSnippet to fetch real-time and historical stock data from Yahoo Finance, and CodeSnippet for creating plots and charts. Next, we define the asset we want to backtest and the historical period. For broader market representation and to observe performance across different market regimes, we'll use the SPDR S&P 500 ETF Trust CodeSnippet over a multi-year period. Download the code. Dans OnePageCode Substack, we select CodeSnippet as our asset, representing a broad market index, and define a date range from 2010 to 2020. The CodeSnippet function fetches the historical data, which includes open, high-low, close, ADJ close, and volume. For backtesting, the ADJ close price is typically used as it accounts for corporate actions like stock splits and dividends, providing a more accurate representation of the asset's true value over time. The CodeSnippet command allows us to quickly inspect the structure and content of the downloaded data frame. 2. Calculating moving averages. Trend-following strategies often rely on moving averages to identify the direction and strength of a trend. We will calculate two types of moving averages: a simple moving average, SMA, and an exponential moving average, EMA. The strategy will use a short-term EMA and a longer-term SMA. Download the code on OnePageCode Substack. Here, CodeSnippet and CodeSnippet define the look-back periods for our moving averages. The CodeSnippet method calculates the exponential weighted moving average. The CodeSnippet parameter in CodeSnippet relates to the smoothing factor, alpha, by the formula CodeSnippet. A smaller CodeSnippet value results in a larger CodeSnippet, giving more weight to recent prices and making the EMA more reactive to price changes. The CodeSnippet method, on the other hand, computes the simple moving average by taking the average of the ADJ close prices over the specified CodeSnippet. Moving average calculations introduce CodeSnippet, not a number, values at the beginning of the data frame, because there isn't enough historical data to compute the average for the initial periods. For instance, a 30-day SMA will have CodeSnippet for the first 29 days. These CodeSnippet values must be removed before proceeding with signal generation and return calculations. Download the code on OnePageCode Substack. The CodeSnippet method removes any rows containing CodeSnippet values. By setting CodeSnippet, the modification is applied directly to our CodeSnippet data frame. This ensures that all subsequent calculations are performed on valid numerical data. 3. Visualizing prices and indicators. Visualizing the price data alongside the moving averages helps us understand their interaction and how they might indicate trends. Download the code on OnePageCode Substack. This code block generates a plot showing the ADJ close price of CodeSnippet along with its 5-day EMA and 30-day SMA. Observing this chart, you can visually identify periods where the short-term EMA crosses above the long-term SMA, a bullish signal, or crosses below, a bearish signal. This visual confirmation is crucial for understanding the basis of our trading strategy. 4. Generating trading signals. The core of our trend-following strategy is based on the crossover of the short-term EMA and the long-term SMA. Our strategy logic is buy/go long signal +1. When the EMA crosses above the SMA, this suggests an upward trend is beginning or strengthening. Exit position/go to cash 0 when the EMA crosses below the SMA. This suggests a downward trend is beginning or strengthening, prompting us to exit our long position to avoid losses. Download the code on OnePatchCode Substack. The code snippet function is a powerful tool for conditional logic in NumPy and Pandas. It checks the condition code snippet. If true, it assigns code snippet to the code snippet column. Otherwise, it assigns code snippet. This creates a binary signal indicating when we should be in the market, long, or out of the market cash. A critical consideration in backtesting is to avoid look-ahead bias. This means that a trading decision made on a given day must only use information available up to and including the close of the previous day. For example, if we generate a signal based on today's moving average crossover, we can only execute the trade at tomorrow's opening price, or at best, today's closing price. To reflect this, we typically shift our signals. If our signal is generated at the close of day code snippet, we assume the trade is executed at the close of day code snippet for simplicity in return calculations, or more realistically, at the open of day code snippet. For daily returns, using the signal from the previous day's close to determine today's position is a common and safe approach. Download the code on OnePatchCode Substack. By shifting eCode snippet column by 1 day using code snippet, we ensure that our trading decision for day code snippet is based on the signal calculated from data up to day code snippet. This prevents look-ahead bias and makes our backtest more realistic. After the shift, the very first row might become code snippet, so we code snippet again. 5. Calculating strategy returns. To evaluate the strategy, we need to calculate its daily returns and compare them against a simple buy-and-hold benchmark. For Financial Times series, it is common practice to use logarithmic returns, log returns, for daily calculations, especially when compounding returns. Log returns are additive, which simplifies aggregation over time. Download the code on OnePatchCode Substack. The code snippet are calculated using code snippet. This represents the daily return if you simply bought and held the asset. The code snippet are then derived by multiplying the code snippet by our code snippet. If the code snippet is code snippet long, the strategy earns the full market return for that day. If the code snippet is code snippet cash, the strategy earns code snippet returns for that day, effectively simulating being out of the market. This multiplication effectively applies our trading logic to the market's daily movements. 6. Constructing the wealth index. A wealth index, also known as a cumulative return series, tracks the hypothetical growth of an initial investment, e.g., $1, over time. It provides a visual representation of the strategy's performance. Since log returns are additive, we need to convert them back to simple returns for compounding, or more directly, use code snippet on the cumulative sum of log returns. Download the code on OnePatchCode Substack. The code snippet method calculates the running total of the log returns. Applying code snippet to this cumulative sum effectively converts the additive log returns back into a multiplicative factor. If we start with an initial investment of $1, code snippet gives us the final value of that $1. This code snippet allows for direct comparison of the growth paths of the benchmark and the strategy. Now, let's visualize these wealth indices to compare the performance of our trend-following strategy against a simple buy-and-hold approach. Download the code on OnePatchCode Substack. This plot visually demonstrates how an initial $1 investment would have grown over the backtesting period for both the buy-and-hold benchmark and our trend-following strategy. This is often the most intuitive way to compare overall performance. 7. Calculating performance metrics. While a visual comparison of wealth indices is informative, quantitative metrics provide a more precise and standardized way to evaluate a strategy's risk and return characteristics. We will calculate annualized return, annualized volatility, Sharpe ratio, and maximum drawdown for both the benchmark and our strategy. First, let's ensure we have access to the code snippet funct, ION, which was likely defined in a previous section. This function is essential for computing maximum drawdown. It typically takes a wealth index and returns the wealth index itself, the running prior peaks, and the drawdowns. Download the code on one Patchcode Substack. The code snippet constant, 252, is a standard approximation for the number of trading days in a year for most major equity markets. This value is crucial for annualizing daily returns and volatility, allowing for comparison across different time frames. Annualized return. Annualized return converts the total return over a period into an equivalent annual rate, making it easier to compare strategies that run for different durations. Download the code on one Patchcode Substack. The annualized return is calculated by taking the geometric average of the daily returns and then compounding it over a year. The formula code snippet effectively scales the total return to an annual basis. Annualized volatility. Annualized volatility measures the standard deviation of daily returns, scaled to an annual basis. It quantifies the degree of price fluctuation or risk associated with the strategy. Download the code on one Patchcode Substack. Volatility is computed by taking the standard deviation of the daily log returns and then multiplying it by the square root of the code snippet. This scales the daily volatility to an annual figure, assuming returns are independently and identically distributed. Sharpe ratio. The Sharpe RATO is a widely used metric to assess risk-adjusted return. It measures the excess return above the risk-free rate, per unit of total risk volatility. A higher Sharpe ratio indicates better risk-adjusted performance. Download the code on one Patchcode Substack. The risk-free rate represents the return on an investment with virtually no risk, such as a short-term government bond. It serves as a baseline for comparison. The Sharpe ratio then tells us how much extra return we get for each unit of risk taken. A Sharpe ratio of 1 or higher is generally considered good, while values below 0.5 might indicate poor risk-adjusted returns. Maximum drawdown. Maximum drawdown, MDD, measures the largest percentage decline from a previous peak in the wealth index. It is a crucial risk metric, indicating the worst possible loss an investor would have incurred if they had bought at a peak and sold at the subsequent trough. Download the code on one Patchcode Substack. The code snippet function, assumed to be available, takes a wealth index and computes the running maximum, peak, and the percentage drop from that peak. We then find the minimum value in the code snippet series, which represents the largest percentage decline. A smaller, less negative, maximum drawdown is desirable, indicating less severe capital loss during downturns. Interpreting the results. After calculating all these metrics, it's essential to interpret what they mean in practical terms. For example, if the strateg Y has a lower annualized return, but also significantly lower volatility and maximum drawdown, its Sharpe ratio might still be competitive, indicating it's more efficient at generating returns for the risk taken. Conversely, a strategy with high returns, but also high volatility and drawdowns might be less appealing due to its higher risk profile. The code snippet example from 2010 to 2020 includes a strong bull market, and a simple buy and hold might perform very well. Our trend-following strategy aims to reduce drawdown during downturns, potentially at the cost of some upside capture during strong rallies. The metrics will quantify this trade-off. 8. Advanced backtesting considerations. To make our backtest more robust and realistic, we can incorporate several advanced considerations. 8.1 Parameter optimization, simple grid search. The performance of our trend-following strategy heavily depends on the chosen code snippet and code snippet parameters. A simple way to explore the impact of different parameters is through a grid search, where we test various combinations and evaluate their performance. This is a basic form of parameter optimization. Download the code on one Patchcode Substack. This nested loop iterates through predefined ranges of code snippet and code snippet. For each combination, it reruns the core backtesting logic MA calculation, signal generation, return calculation, wealth index, and metric computation. The results, Sharpe ratio, return, drawdown, are SD. ORD, allowing us to identify which parameter combinations yielded the best performance according to a chosen metric, e.g., highest Sharpe ratio. This process highlights how strategy performance can be sensitive to parameter choices and is a fundamental step in strategy development. 8.2. Incorporating transaction costs. In a real trading environment, every trade incurs costs, commissions, slippage, bid-ask spread. Ignoring these costs can significantly inflate backtested profits. We can model a simple fixed percentage transaction cost. This cost is applied whenever a trade occurs, i.e., when the signal changes. Download the code on OnePageCode Substack. Transaction costs are applied whenever the code snippet changes, indicating a buy or sell action. We calculate code snippet by taking the absolute difference of the code snippet column. Any non-zero value indicates a change in position. A simple percentage cost is then subtracted from the strategy's daily log returns. The plot and recalculated metrics clearly show the impact of these costs, often significantly eroding profitability, especially for strategies with high turnover. 8.3. Modularizing the backtest with a function. Encapsulating the entire backtesting logic into a reusable function promotes modularity, makes the code cleaner, and facilitates testing different parameters or assets. Download the code on OnePageCode Substack. The code snippet function now encapsulates the entire process. It takes the asset date array, NG, MA spans, and optional risk-free rate and transaction costs as inputs. It returns the detailed data frame, useful for plotting, and a dictionary of all calculated performance metrics. This modular approach allows for easy testing of different assets, e.g., code snippet as shown in the example usage, time periods, and strategy parameters, making the backtesting workflow efficient and scalable. 8.4. Conceptualizing risk management rules. While not explicitly coded in this basic backtest, a crucial aspect of real-world trading is risk management. Simple rules like stop-loss and take-profit orders can significantly alter a strategy's risk profile. Stop-loss, a predetermined price level at which a position is automatically closed to limit potential losses. For example, if the asset price drops 5% from its entry price, exit the trade. Take profit, a predetermined price level at which a position is closed to lock-in gains. For instance, if the asset price increases by 10%, exit the trade. These rules would be integrated into the signal generation and return calculation steps, often requiring more granular intraday data or more complex logic to simulate their effects accurately. However, even a conceptual understanding of their importance is vital for building robust trading strategies. Consolidating backtesting fundamentals. This chapter has covered the foundational elements of quantitative trading strategy development, specifically focusing on the critical process of backtesting and the essential risk metric of maximum drawdown. As we transition to more advanced topics, it is crucial to consolidate these core concepts. The backtesting framework, a systematic approach. Backtesting is the cornerstone of quantitative trading, allowing us to simulate a strategy's performance using historical data. It provides empirical evidence of how a strategy would have performed, informing our understanding of its potential profitability and risk characteristics. While not a guarantee of future performance, a robust backtest is indispensable for validating trading ideas. A typical backtesting framework involves several key stages. 1. Data acquisition and preparation. Gathering clean, accurate historical market data, e.g., prices, volumes. 2. Signal generation. Defining the rules or algorithms that generate buy-sell signals based on market data. 3. Trade execution simulation. Simulating trades based on signals, accounting for realistic execution mechanics like slippage and transaction costs. 4. Performance attribution. Calculating key metrics to evaluate the strategy's profitability, risk, and efficiency. Let's illustrate a conceptual skeleton of a backtesting function. emphasizing the logical flow. Download the code on one patch code Substack. This initial function code snippet provides a high-level view of the process. It defines a placeholder for code snippet, then conceptually outlines where signal generation, trade execution, and performance calculation would occur. The key takeaway here is the structured, sequential nature of backtesting. We use code snippet and code snippet extensively for data handling due to their time series capabilities. Download the code on one patch code Substack. Here, we generate code snippet using code snippet and code snippet to simulate a price series. We then pass this data to our code snippet to demonstrate its usage. The output code snippet would conceptually represent the growth of our initial capital over time, based on the simulated strategy. This immediate application helps solidify the abstract framework into a concrete, though simplified, example. Backtesting caveats and best practices. While backtesting is powerful, it is fraught with potential pitfalls that can lead to misleading results. A sophisticated quantitative trader must be acutely aware of these limitations. Look-ahead bias, using future information that would not have been available at the time of the trade. For instance, calculating a moving average using data points that occur after the signal is generated. This is a critical error and often subtle. Best practice: always lag data or ensure all calculations only use data available up to the point of decision. Survivorship bias, using data only from currently existing assets, ignoring those that have delisted or failed. This inflates historical performance. Best practice: use comprehensive historical databases that include delisted securities. Data snooping/overfitting, iteratively testing many strategies on the same historical data until one appears profitable. This strategy is likely to fail out of sample. Best practice: use out-of-sample testing, cross-validation, and be skeptical of strategies with too many parameters. Transaction costs and slippage, failing to account for commissions, exchange fees, and the price impact of large orders. These can significantly erode profitability. Best practice: include realistic estimates for these costs in the backtest. Liquidity constraints, assuming trades can be executed at the desired price and quantity without affecting the market. Large orders in illiquid markets can lead to significant market impact. Best practice: model market impact or limit trade sizes based on average daily volume. Regime changes. Market dynamics evolve. A strategy optimized for one market regime, e.g., low volatility, may perform poorly in another, e.g., high volatility. Best practice: test strategies across different market regimes and consider adaptive strategies. Understanding these caveats is not just academic. It directly impacts the reliability of your backtest results and, consequently, the viability of your trading strategy. Maximum Drawdown, a critical risk metric. Maximum Drawdown, MDD, is a crucial metric for assessing the downside risk of an investment strategy. It represents the largest peak-to-trough decline in the value of a portfolio or equity curve over a specific period before a new peak is achieved. MDD quantifies the worst historical loss an investor would have suffered if they had invested at the peak and sold at the bottom of the subsequent decline. While MDD only captures the single worst event and doesn't account for the frequency or duration of drawdowns, it provides a vivid illustration of potential capital impairment. A strategy with a high Sharpe ratio, but also a very high MDD, might indicate a strategy that performs well most of the time, but carries significant tail risk. Let's revisit the calculation of maximum drawdown step by step with a clear code example. We'll use a sample equity curve. Download the code on one patch code Substack. We begin by generating a code snippet using code snippet for random daily returns and code snippet for cumulative product calculation and date indexing. This curve simulates the growth of an initial investment of 1.0. This step is crucial as MDD is calculated directly from the equity curve. Download the code on one patch code Substack. The code snippet, or code snippet, is essential. For each point in time, it tracks the highest value the equity curve has reached so far. This allows us to measure declines from the most recent peak. Download the code on one patch code Substack. Here, code snippet is calculated for every point in the equity CU. A positive value means the current value is a new peak, drawdown is 0, and a negative value indicates a decline from the preceding peak. This intermediate step provides the raw data for finding the maximum. Download the code on one patch code Substack. Finally, code snippet is the smallest, most negative value in the code snippet series. We also include a useful addition to identify the start, peak, and end, trough dates of this maximum drawdown period, providing more context to the single number. This detailed, step-by-step approach ensures full understanding of how MDD is derived. Key performance measures beyond MDD. While MDD is critical for risk assessment, a comprehensive evaluation of a trading strategy requires a suite of performance metrics. These typically include annualized return, the average compounded return per year, indicating profitability. Annualized volatility, standard deviation of returns measures the dispersion of returns, indicating the level of risk or fluctuation. Sharpe ratio, a risk-adjusted return metric, calculated as the excess return per unit of volatility. It helps compare strategies with different risk profiles. Sortino ratio, similar to Sharpe, but only considers downside volatility, providing a more focused view of bad risk. Kalmar ratio, annualized return divided by maximum drawdown, another risk-adjusted return metric focusing on the worst historical loss. These metrics, when viewed together, paint a more complete picture of a strategy's historical performance, helping traders make informed decisions. Application to a trend-following strategy. The concepts of backtesting and risk assessment were practically applied to a trend-following strategy. Trend-following strategies aim to profit from sustained price movements in one direction. A common implementation involves using moving averages to identify trends. For instance, a simple moving average crossover strategy might generate a buy signal when a short-term moving average crosses above a long-term moving average, indicating an emerging uptrend. Conversely, a sell signal is generated when the short-term average crosses below the long-term average. Let's quickly review the core logic of generating signals for a simple trend-following strategy. Download the code on one patch code Substack. We start by creating code snippet data and defining our code snippet and code snippet for the moving averages. Code snippet is used to efficiently compute these averages over the specified periods. This sets up the foundation for our trend-following logic. Download the code on one patch code Substack. Here, we generate the preliminary code snippet. A value of code snippet indicates a potential long position, short MA above long MA. Code snippet indicates a potential short position, short MA below long MA, and code snippet indicates no clear trend or transition. The code snippet is important to handle the initial code snippet values that result from the Rayleigh mean calculation. This is a core component of many trend-following strategies. Key takeaways for quantitative traders. The discussions on backtesting and maximum drawdown provide several crucial lessons for aspiring and experienced quantitative traders. Backtesting is paramount, but not perfect. It's the primary tool for strategy validation, but its results are only as good as the underlying data and assumptions. Always be critical of your backtest. Risk is as important as return. Metrics like maximum drawdown are essential for understanding potential capital loss and should be considered alongside profitability metrics. A high return with unacceptable risk is not a viable strategy. Realistic assumptions are vital. Ignoring transaction costs, slippage, and liquidity can lead to strategies that appear profitable on paper but fail in live trading. Beware of biases. Look-ahead bias, survivorship bias, and data snooping are common pitfalls that can invalidate backtest results. Rigorous methodology is key. Performance metrics tell a story. Understand what each metric, Sharpe, Kalmar, MDD, volatility, tells you about your strategy's performance and risk profile. No single metric provides the complete picture. Continuous learning and adaptation. Markets evolve, and so should your strategies and understanding of backtesting best practices. Looking ahead, having established a solid foundation in backtesting methodologies and risk assessment, we are now equipped to delve into more complex strategy types. The next chapter will explore statistical arbitrage, a class of strategies that identify and exploit temporary price discrepancies between statistically related assets. This will build upon the data analysis and quantitative techniques we have mastered, moving towards more sophisticated forms of market exploitation.